So today I'm going to tell you how to survive what some have called a mortgage crisis.
Across the country, mortgage deals on
Mean
offer
that they'd be
yesterday
paying about
have been
£6,000
withdrawn
a year
today.
extra.
The things you need to know which could cost you thousands of pounds if you don't understand. So in 2022 we went through the worst crisis for mortgages since the great financial crisis. Mortgages were pulled, people rushed in to lock rates, purchases fell through, and a lot of people lost out on their dream home. But what now? I mean, is it going to happen again? And if so, how can we prepare? Well, in this video, I'm going to tell you the key things that you need to know to prepare. This includes the big aspect about mortgages, which I think most people don't understand. And I'm going to tell you 3 things you need to be looking out for to keep an eye on the future. And most importantly, why a fixed rate mortgage could perhaps be right for you, even if comparatively you end up losing some money. But first, I need to make sure we're all on the same page before I start talking strategies. What I'm going to be talking about is what's called the base rate. Now, this is the rate that the Bank of England charges other banks and other lenders when they borrow money, and it's currently at 3.5%, but it's predicted to rise further. So the base rate is basically the reference point for all other lending, be it mortgages, loans, other types of credit. Kind of think of it like the tide that lifts all boats, or drops, not sinks all boats. You know what I mean. Anyway, the theory is that the base rate goes up when the Bank of England wants to put the brakes on inflation, known as tightening, or down if it wants to make borrowing easier and stimulate a bit more growth, loosening. For the base rate, what we need to look out for right now, let's be honest, is inflation figures. Right now for central bankers, managing inflation is the only game in town. So where are we right now? Well, the Bank of England predicts inflation will fall quite sharply. But bear in mind they also came out with such greatest hits as inflation is transitory. But if inflation does fall, it could be the case that rates fall as well. Because keep in mind that the Bank of England doesn't really want to raise rates. The UK economy is not in a particularly good place at this moment in time. We have long-standing productivity issues, trade issues due to you-know-what, and what's called a moron premium, which I'm not going to go into, but I think you kind of know what that's about. Anyway, there's also a big difference between here and the US that not all people know, which is that the US have much longer mortgage rates, all the way up to 30-year mortgages. So when rates rise by the Fed, yes, it's painful, but not potentially ruinous because people don't have that mortgage debt issue that we have here. In fact, there's nearly 9 million outstanding residential mortgages in the United Kingdom, according to UK Finance. About 20% of those loans are trackers or variables. The rest are fixed rate loans, which will need financing at some point and will probably be at much higher rates. And if we have a look at this data from BuiltPlace, it appears that at least 1.2 million fixed rates are going to come off in 2023 that are currently on a rate lower than 2.5%. That is going to have a big impact on people's disposable incomes. So now with that in mind, let's talk about the 2 main types of mortgages. But this is main, not all mortgages. One is a fixed rate mortgage, and a fixed rate mortgage is simple enough. The interest rate is fixed by a set amount of time and won't be affected by the Bank of England base rate rises or fluctuations in the market during that period. Once you've taken out a fixed rate mortgage, you're going to be locked in to the introductory rate for a set period of time, and if you leave, you'll typically be subject to exit fees. The normal fixed rate period in the UK tends to be from 2 to 5 years of the term. During this time, you know exactly how much you'll be paying each month, which is great, and it won't change until the fixed period has expired. And it's the certainty of fixed rate mortgages that makes them really appealing for some who want to budget. The downside is once you're locked into that term, you'll find it very difficult to switch again, and there sometimes can be hefty penalties if you do decide that you want to change mortgage rates. You also won't benefit from the fall in interest rates should that occur during your term. So let's talk about number 2, variable rate mortgages. And variable rate mortgages is a product which the interest rate can shift at any time, either higher or to a lower amount. Now this type of mortgage is affected by the Bank of England's base rate as I was chatting about earlier, as well as some other factors. But there are subcategories of variable rates here. Standard variable rates, discounted variable rates, trackers. Now have you ever wondered what is the difference between the standard variable rate and a tracker? Well, a standard variable rate is basically a variable rate of interest that a lender's standard mortgage is set. Although lenders do normally change their standard variable rate as a result of the Bank of England's base rate changing, they're not obliged to by the same amount. This is important. You can also get a discounted rate, which as the name suggests has a discount on the standard variable rate. Now the key difference with a tracker rate is that the mortgage, as the name suggests, tracks by a pre-arranged amount typically the Bank of England base rate plus a few percentage points. And effectively, the benefit of here is that you're guaranteed to get any falls in interest rates if there are falls in interest rates, but also the downside, any rises will potentially be passed on to you as well. But you might have noticed I haven't told you anything about what risk is worth taking. And for that, I need you to wait to the next part. So the first layer you need to understand is the economic cycle. Our entire economic history is a mixture of cycles, from expansion, peak, recession, and recovery. The central bank have the unenviable job of trying to keep the economy in that Goldilocks era, where it's just enough growth, but not too much that there becomes really high inflation. So when we're approaching the peak, this normally means that inflation is starting to creep up, because there's more money in the economy chasing fewer goods, causing inflation. So the central bank, to counteract that, rises the base rate. And by raising the base rate, you're making it harder for people to borrow, which ideally puts the brakes a bit on the economy. And then in a normal cycle, something, and we don't know what that is, tends to break, be it a banking crash, pandemic, or just a self-reinforcing collapsing of demand. And that tends to go into a recession. The central bank then tries to encourage spending by dropping interest rates, and the cycle repeats. Sounds simple enough, right? Well, this cycle has a big impact on mortgage rates, and the timing of these cycles can affect your decision on what type of mortgage you get. And where we are in the economic cycle can give you an idea of whether your mortgage rate, comparatively to how it's been before, is going to be high or low. Okay, well, you might be thinking then, well, George, if what you said is true, then it's quite easy then, isn't it? All I need to do is get a fixed rate mortgage at the bottom of where the market is, where the base rate is low, and then fix for as long as I can. Or if I'm at the top right now, I just need to wait on a variable rate until it's low again. Sounds easy. Or even better, maybe get a discounted variable rate and ride the discount down to the bottom. Well, sadly not, unfortunately. It's not that simple. While what I've said is sort of right in theory, it could turn out completely wrong in reality. And here's 3 reasons why it isn't as easy as that. 1, it just assumes that all recessions are generally credit related, sort of irrational exuberance and all that. And it's on the assumption you can sort of see it coming. The problem is no one really knows how long the economic cycles are going to last. We've just come off one of the longest bull runs ever. You are guessing when perhaps a pandemic might come along, but prior to that, from 2011 to 2020, almost every year in the press there was talks about an upcoming recession. It also doesn't consider things like one of the biggest spikes in UK interest rate history, which is Black Wednesday in 1992, when the UK crashed out of the RM. Or maybe dealing with inflationary shocks like now or in the 1970s. So number 2 here is it gives us no idea about secular changes in interest rates. So for the last 15 years or so, interest rates have been way lower than they would normally have been. So if you're counting on an up and down, that might not actually come this time. And 3, it doesn't actually tell us what drives fixed rate mortgages. In fact, on this point, if what I was saying is true, that mortgage rates are linked to the base rate, which is linked to the economic cycle, why on the 23rd of September 22, when the ill-fated mini-budget came around, the economy wasn't looking so hot? There were inflation expectations, but it didn't change that much through that period. But yet we saw huge spikes in fixed-rate mortgages. Basically, if things are so predictable, what was all that madness about? Well, I'm about to tell you. So what I need to tell you about layer 2 is swap rates. And to quote The Art of War, if you know your enemy and know yourself, you need not fear the result of 100 battles. So to help you protect yourself in this part, I'm going to ask you to do something which might send chills down your spine. I'm going to ask you to imagine you're a banker. Anyway, let's pretend this was the old days and you were quite literally the only bank in town. Anyway, imagine that you've now got lots of people who want to get mortgage rates at, say, for 5 years. Well, that's going to create a problem for you, isn't it? You don't know what's going to happen in 5 years. You've got no idea if the rate you're going to give up today is going to be a great deal for you or your customer. Okay, so let's fast forward to modern day. Banks, at the end of the day, still have this problem, but on a global scale, and they need to solve it. And this is where swaps come in, which is, oddly for finance, a rare example where it sounds exactly like what it is. A swap is a derivative contract, which means that one party exchanges or swaps the value of cash flows of one asset for another. So swap rates are effectively an agreement between 2 parties where they agree to exchange one stream of future interest payments for another. So do you remember the problem for that only bank in town? Well, a swap allows a mortgage lender to mitigate the interest rate risk on a fixed term mortgage. So think about it this way. It's the swap rate, which is the rate that the mortgage lender must pay in order to mitigate that change in interest rate risk. So what the swap rates are based on are somewhat related to, but crucially not the same as the base rate. So this can be factors like inflation, prices, fuel, gas, and just the general economy data, and that'll feed into the forecasts. So what does this tell us, and why might that be useful to know? Well, if there's a big difference with the Bank of England base rate and the swap rate, the gap between the two is effectively the market's take on protecting the interest rate risk. The gap, what you're paying in many ways, is the cost right now to lock in certainty. So let's just think about that for a moment. When would the cost to lock in certainty be very high? Okay, without giving you the answer, look, it's when things look uncertain. Maybe perhaps when a UK Chancellor comes out with a policy that requires a huge amount of debt issuance. So for your side, why is it useful for you to know that the cost of certainty can vary? Well, like base rates, you are still guessing at the end of the day. But perhaps if sentiment goes a little bit crazy, like perhaps when mortgage rates are being taken off the shelf left, right and centre, you can at least understand that at that point the cost of that certainty, which you're paying in your fixed rate, is quite high. And you might potentially be paying a premium to lock that in. Now that's not to say it's not right for you to take a fixed, or it is right for you to take a fixed, but you just have to be aware of that sentiment element, and like any decision, you can consider it now as part of your thinking process. Okay, so what actually can you do? So I've talked about the theory, now you've got a good idea what to look out for. I also really recognise that depending on your own personal circumstances, these mortgage rate increases can go from an inconvenience to genuinely creating huge stress on if you can afford this. So I said that I'd help you protect yourself. Look, you've got a good degree of knowledge now what to look out for, but what can you actually do? Remember, everyone watching, this is my guide, but as always, I'd strongly suggest getting advice specific to you. So the first thing that we all need to do is we need to work out what the potential impact is. There's a description in the video to a Lloyd's calculator which shows you exactly how much you'll pay depending on the rate increase. So that's simply a case of having a look round, getting an idea at the best current rates and working out the impact from you, so you know what firstly you're dealing with. You then need to check this against your own expenditure on a monthly basis and make sure it's affordable. There are quite a few housekeeping, see what I did there, things that you can do. So 1, don't just take the first deal with your existing lender. Make sure you shop around and ideally get an advice from an independent whole of market advisor who can help you understand the whole of the market, how it relates to you. 2, you could consider revaluing your home if it could mean it falls into a more favourable loan to value ratio, getting you access to a better deal. 3, when you look at this, there might be an overpayment strategy that you could do in advance of the new mortgage, where actually it can reduce your loan to value ratio when you remortgage and potentially gets you a better deal. So just be aware of that when you're working it out. 4, consider this against other savings. Remember, a mortgage rate rise should make you question your cash holdings. Why am I now paying 5% on my mortgage and getting 1% on my cash? Well, it's probably because you're getting a bad deal from your cash. 5, bear in mind you always need an emergency fund. I repeat, you always need an emergency fund, but there's no reason why that fund can't earn you good interest. 6, you also need to be mindful of your credit score. If you can improve that or at least maintain that if it's already good, that will put you in a good position. 7, as a general rule, it's a good idea to start investigating which deals are available up to 6 months before the end of your mortgage deal is due, particularly if you're worrying about rates rising in the months to come. Many remortgage offers are valid for between 3 and 6 months from the date they're issued. This means if you've got 6 months left to run on your existing deal, you can potentially still apply for a new mortgage and secure a new rate. The advantage of working this out is that 1, you've got an offer on the table, but 2, also that you don't have to potentially fall onto the standard variable rate, which could be higher. So there you go, my final point that I mentioned from earlier in the video. Why might someone who paid more for a fixed rate mortgage be better off than someone who had timed the market perfectly and has a variable rate? It's simple really, it's more personal than finance. I know from experience speaking to thousands of people about money, for some, even the thought of the unknown on mortgage rates cause concern or unease. If you think about it this way, how much is that stress worth to you? What's your hourly rate? Like the swap position, what do you personally put the price of certainty on? And there is nothing wrong, and I mean absolutely nothing wrong with accepting that you'd rather potentially pay a little bit more than try and gamble on the unknown. So in this video, I've not just told you what to look out for, I've also told you what you can do. But there is something missing that you do need to know about: house prices. So whether you're worried about a house price crash this year or being a buy-to-let investor, I've got the perfect videos that you need to watch.